Yeah, exactly. So I'm Jonatan. Pleasure to meet you, and great to have you all here. Venture is a pretty opaque world. So first-time founders are basically left in the dark when it comes to venture capital. It's they even very prolific entrepreneurs, they maybe raise like 10 times in their life, right? Venture capitalists, they're part of 10 races a year probably, which leaves this huge information asymmetry that Professor Tessone introduced previously. Thank you for that. And my goal today is to lower that a little bit. First, I'll explain what venture capital is, so that's not clear to everyone. I'll explain a little bit how they think, which will inform our third topic, which is probably more applicable to everyone here, hopefully. And that is how to raise money from venture capitalists. So venture capital basically consists of 3 activities. There are 3 things that they do. It's invest money, advise founders, and raise their own funds. So investment consists of basically deciding, okay, what do we invest in, right? Finding those opportunities, evaluating them, and then finally executing the deals, let's say signing the term sheets, wiring the money, etc. Advising, this is probably the most, let's say, let me start the timer also, the most variable one in terms of how good it is, how valuable it is to founders. Yeah, exactly. And and how frequent it is. Like if you have 200 portfolio companies in a fund, and there are 3 partners, you can calculate how much time you're going to get from these partners, if you're a small check in the fund. But there's also control, right? They need to not say control what you're doing, but they need to maintain their fiduciary duty of, say, sitting on the board and deciding things for you or with you. And now getting the next fundraise, that's an interesting topic, as that's also not clear to many startup founders, that the tables are turned, the venture capitalists sit on the other side and try to get money for their own startup, which is a fund, right? And this happens approximately every 5 years or so. Now, these 3 activities have something in common. They don't scale very well at all. And given these 3 things, there are 2 things that I think are quite clear, right? Networks are the most important asset to a VC. Secondly, the main constraint of a VC fund is still the time of the actual people working at the fund. So scaling VC in the sense of, oh, I sell my product, I sell a gadget at diminishing additional cost, just doesn't work the same way in venture capital due to these constraints. Now, there are 2 approaches, like how this can be solved. One interesting one, in my opinion, coming from rather the engineering side, is it's a 10x VC, like 10x engineer, but this is a 10x VC that wants to leverage data, leverage technology to multiply their own output, basically. Now, there are examples of that. I would like to say we are one of them. The second one is kind of a brand VC, which is like, oh, they get millions of followers on TikTok, and they start raising money on that, and they have massive networks. This actually works. These funds get raised. Then there's the A16Cs of the world that just turn out to become a massive media brand that just output so much content that they become these brands. But the underlying structures of the funds are still pretty much the same. So let me cover that very shortly. You may have heard the terms LP, GP. These are the partners of a partnership that is on the basis of every fund. The limited partner is the person that invests the money. They have loads of capital, so they want to deploy it into a VC fund, and in return they get a promise of returns at some point. The GP is the general partner. They're basically the CEO and founder of the fund, usually. They put in most of their own, or a significant amount at least, of their own wealth into the fund. They decide all the investment decisions, essentially. And then probably if you're ever raising capital from a venture capital fund, the first person that you'll maybe talk to, unless you know a GP at a fund, is someone from the investment team. So that's an associate or a principal, someone who deals with sourcing all the deals, that goes out to these events or to conferences and talks to founders. And if it goes really, really well, then you'll talk to someone from the back office, and then you'll sign the docs and they'll wire the money. You have to tell them your bank account and so on. That will be the back office. And if you're a larger fund, then you also have talent or maybe operations people that work for your portfolio companies. And if you're a 10x VC, then you also have an engineering department with people who build tools for you. So this whole setup is only temporary. What do they do once all the money is invested, right? Well, as it turns out, venture funds usually only live for like 15 years, so they have a 15-year time horizon. And of those 15 years, only the first 3 to 5 years are used for actually investing. After that, they invested all the capital and they need to wait for these investments to accrue and to gain in value until they can at some point exit it. So at the latest, around the 3 to 5 year mark, they go out to start raising their own funds. They approach the new LPs or the old LPs to get more funds. Now, these 15 years are still quite long, but is it long enough to make actual returns on investments? And that leads us into kind of understanding how VCs think, because they happen to think a lot about money. So let's understand the actual money flows of venture capital shortly. There are 2 ways that VCs can make money, or do make money. The secure one, management fees, 2% per year of the entire fund. The less secure one, up to skill, is the carried interest. And that depends entirely on how the fund does, right? So you may think, okay, 2% doesn't sound like too much, like it's basically nothing of the entire fund, but it's each year for 10 years. And that means it's 20% of the entire fund goes to just salaries, expenses, legal, and so on. But it's kind of necessary. The carried interest, the so-called carry, is also necessary for incentive alignment. If I'm an investor in the fund, like I would like my partner, my GP, to work towards generating returns for me. So investing in the best companies possible, right? So that these at some point make an exit and I can get money back. And in that case, I want my GP to get also some money back so that he's motivated to do this, or she. And if I'm a GP, I want to see the fruit of my work, and I want to be rewarded for having put in the, let's say, the extra work of doing really good investments. Let's focus shortly on the carry. Like, how do we actually get these potentially very, very high returns that are based entirely on what the venture fund invests in? Well, the simple answer is a return only happens when there's an exit. And without these returns, there's not going to be a next fund. There's not going to be any fund either. So starting at the left side, we have basically the input parameters of what is decided at the beginning of the fund, which is kind of how big the fund, what am I going to invest in, how many investments am I going to have in my portfolio, what are my targets for percentage ownership of a company, right? And then it goes into this massive venture machine, which is based on the decisions on the fund, but also market conditions and what other funds do. And what comes out, basically 2 things. One is either the company that we invested in has wound down, is no longer existent for various reasons, or there was an exit. And VCs basically only think about one thing, and that's the exit part. And not even just the exits, it's how much of an exit is it, right? If it's 1x, I'm like, oh great, I put my money away for 10 years and I got back exactly the same amount. What am I going to do with this? It doesn't help me at all. And the reason they think about this like this is because of how venture returns look statistically. They follow very much a power law. So a very small percentage of the investments that a fund does represents a vast majority of the actual returns of this fund. And that if you go one level higher in the, let's say, capital stack, then it works the same way for funds. Only a small minority of funds return a vast majority of, say, actual returns for funds as an asset class. Now, this influences what they invest in, of course, or what VCs invest in, right? And what they focus on, what they spend their time on. For example, many of the businesses that come across a VC's desk are never going to get venture funded because they're just not of this specific profile that they can return the entire fund in one investment. Right? It's never going to happen that it's 100 or 1,000x. So how do they pick these specific companies? Well, let's look shortly at how decisions are made. There are some external factors, say call them fund influences. There are some internal factors of the startup. Let's call them startup factors, right? And the fund influences can be really, really silly, like, oh, you just happen to be talking to the person at the wrong time or the wrong person, or they happen to already have invested in this related area, so they're kind of blocked and don't want to take competitive investments. It's actually a good reason. Or the person you're talking to happens to be on vacation when you want to raise, and like, oh, it just doesn't work out for whatever reason. Know this, if this happens to you, don't feel bad. It happens to basically everyone, right? Like an average VC probably gets hundreds and hundreds of deals across their virtual desk every week. They can't possibly screen everything unless they're like a 10x or 100x VC. So let's look at the startup factors, the things that you can actually influence. That's team. Does the problem fit to the founders? Its market. Is this a massive, massive market that you can capture reasonably? Let's look at the product. Is it something truly new, something that no one else can or has done for whatever reason? And are you able to execute on that? And then there are some, say, admin factors that can change, like what are the terms of the deal, how expensive is it, who else is in the round potentially, and then there's the, let's say, the long-term setup of, okay, are the founders on equal terms, etc. Finally, know this also, this decision-making is more of an art than a science, right? It's very much gut feeling for some, more quant for others. There are some things that just like happen to trigger VCs that they really like some examples. You made exits before, like, oh, it's a serial entrepreneur, let me invest, like, please take my money. Or you have some initial traction, that's great. That shows product market fit. Not a lot of companies have that. Or you're just very, very early into something completely new that no one else has done before. This is called category defining. That's something that I personally am probably like liable to invest in. So in summary, total AUM of the fund really drives the motivation of VCs. And the fund size actually determines how, where, and into what you invest. There are massive, massive risks of failure in this asset class. Like, we don't know how many startups fail before they even get in front of a VC. And that means each of these investments has to be able to make a massive return. The most important skill for VC is still, do I invest or do I don't I, right? So now we know what it is. We know kind of how they think a little bit. What do we do with this information? Don't worry, I'm going to give you the permit, the EC guide, and you'll have to bring your big brains. First question, should you even raise money from a venture capitalist, right? So three things to consider there is, can I bootstrap this myself? Can I fund it through some other way? Can I do it part-time? Then maybe you don't need to give away equity in your company. Second question, if you pass that one, is this market really venture scale, or this business really, really huge scale that it's, I don't know, multiple billions of dollars worth total? Right? These are the types of numbers that VCs think in, just so you're aware. Like, it's not, we're going to make a few dollars. It's really has to be this huge. And third, I think this is one of the most, sorry? Yeah. I mean, there are multiple markets that have this space, right? And then you can always drill down and say, okay, is it total addressable market, or is it actual something that you is realistically able to capture, right? But just for the orders of magnitude. No, market size. Yeah, not. Well, there are billion dollar companies, of course, unicorns and decacorns and so on. But yeah, you don't have to be that before you start raising a venture. That would be, yeah. If you do, please talk to me. Yeah. And the third option that I think is really interesting is like, would you yourself be able to invest all your money, risk everything to do this thing, or are you even going to build this no matter what? That's something we see with founders, right? They basically take maybe not all their private money, but they bet their entire life on this thing working out because they can't see the world without it. And I think that's something that you need to be slightly crazy to start a company, and people that are really crazy and do this for real with this conviction, they're just unstoppable. So if all this fits, right? All right, let's go. You decided, but maybe now you feel like Doge, like, oh, what did I do? You need money, but how money? Don't worry, there are some basic items that I think you could check the boxes of before you start talking to VCs. First one being, how much money do you want to raise? It's not a question of what is the least amount of money that you actually need. It's a question of how much do you want to raise, right? And those are different things. It's influenced partly by what you need, but also how fast can you spend it. If you're able to raise like $50 million and you're one person, you can't possibly spend that much money in like a reasonable time frame. There are people that do this. The second point that is slightly less interesting is, okay, what are my instruments to choose from? How do I take on money? Like, this is all super boring legal stuff, but it happens to be really important. My one recommendation, if it's the first time that you're doing this, probably go for a safe. You literally just download it from Y Combinator's website, fill in the blanks, and sign it. Yeah, that's it. It's like, you don't need a lawyer, basically, but I would probably suggest that you get a lawyer. Now we get to the more specific points, and that gets into who do you talk to now? What VCs should you be targeting? So are they in your stage? Is it someone you know maybe? Is it a fit for your expertise needed in your capital base? These are all questions that I would ask myself. And when you decide to do this, when you have all these boxes checked, there's only doing, right? No trying. You don't go out and like, oh, maybe I'll raise let's see. No, okay, no, wait, no, I pull back. Like, that's a really strong counter signal of not having conviction. And if you don't have this conviction, then maybe you shouldn't be racing right now. Maybe go back and look at, is it the right product? Do I have the right team around me? And take a few seconds to say, go back in yourself and think about this. And when you do this, right, I recommend you read this book called Venture Deals. It's super simple. It's called Venture Deals. Be smarter than your lawyers and your venture capitalists. I'm sure you're all able to do that. So really recommended. This is from my desk. Now, then when you have that, you can start taking calls. And since this process is very like opaque, I recommend looking at the slide shortly and getting a feeling for what actually happens during a venture capital raise. As a startup, from your perspective, you prepare all the orange stuff, and then you run the process. You have to push through the process, basically. It's not going to be easy, and hopefully end up at the handshake at the end. Now, you identified the target VCs, you have 100% of your long list. Maybe you reached out or you got an introduction. That's the optimal way. You have a friend who invested or who's invested in by this VC. They introduce you. That's like the best way to get to these people. If you don't have that, if you cold call them, like send them an email through their contact odds are you'll never get a response, honestly, unfortunately. Like, maybe it'll work, but the conversion rate is much, much lower. Do I need to speed up? Yes. Okay. Right. And then a bunch of things happen. You start taking more and more calls. You get some, hopefully, momentum into your round. And then it gets to the negotiation part of, okay, now I have a couple of VCs that are potentially interested. Just know this, a word of advice. Nothing actually ever happened until you have the money on your account. Like, in Sweden, there's a saying, don't call hello before you're over the river. And that's exactly it. Like, until the ink is on the paper and the money is in the bank, you have nothing, right? Not to be pessimistic. So now we talked a bit about what the mechanics are and so on. Now some simple rules, some advice for the road maybe. VCs always want to pass on you. They want to get past and get to the good stuff, wherever that is. Maybe you are the good stuff. VCs are very often followers. So in agent-based simulations, they're they're a flock, right? They follow others in terms of topics and in terms of momentum of a round. If they smell the slightest incline of desperation in your eyes, that you actually need this money that you're desperately asking for, then they'll run away for whatever reason. Now we talked very generally about all venture capitalist firms, but like to make an example of a totally random one, namely Inflection, which is where I work, we believe that we are kind of at an inflection point in society, driven very much by technology, but also by geopolitical things, leading to more uncertainty. We're pushed into or driven to more secure technologies, one of them being crypto as a resource of independent, sovereign financial systems. Oh, that was my 20-minute timer. Perfect. Yeah, we do approximately $1 million investments per check in the earliest stages. So if you haven't yet raised money from a VC, we are the right firm to talk to, given all the other things that I mentioned. We have a traditional venture scale time horizon, which is not always the case in crypto specifically, as some funds have a hedge fund that trades liquid tokens. They have maybe some other multiple funds that do other things, right? We have one fund that we invest into venture. We can invest in tokens, but don't always. My hope after this is that at least one of you go out and start a venture-backed company. If you're not convinced yet, then please reach out. These are my emails, my Telegram handle, or you, of course, talk now. Yeah, I hope this is actually converting into something. If it's only knowledge and slightly lowering the information asymmetry, I would be a very, very happy person. Thank you.